being responsible is the overriding philosophy for all insurance, period. So with life insurance, as you say, well, how will this affect me? Insurance should be used, and you'll have to excuse me the way that my office is set up. I have to turn my head to read a screen. So you're going to cover losses that could derail your family's future. Not only your family, someday those of you may run a business or be part owner in a business. So ensuring the risks in a business, life insurance is part of that. I'll explain how. Again, it has the overriding philosophy of, well, we need to be responsible. And so insurance is basically a cost shifting. I mean, you can do what's called self-insuring, where you do not buy any insurance at all. And if you're Bill Gates or if you're Warren Buffett and you said, I've got enough assets that if something happened, I can just pay for it out of my pocket, you don't need to transfer that risk to an insurance company by paying them money to cover it in case something happens. And so that's what insurance is doing. Insurance balances the relatively small and certain loss of ongoing premiums against low probability, high cost risks. Okay, so we're going to talk about life insurance in particular. So the whole time we talk, keep in mind responsibility, low cost, high risk. Okay, so learning goals. I don't know how your test is going to go. I don't know exactly what's going to be on there. So if there are certain things, I remember when I was in school, I'm a UM grad myself, there were certain things that I could pick up if I knew a teacher over the course of a semester and say, uh-oh, this looks like something that's going to be on the test. Feel free to stop and ask me more questions about it. So here's the first page. If I was in your class, I'd say, I'll bet you they're going to ask about what some of the learning goals are. So we're going to explain the concept of risk and the basics of underwriting, the primary reasons for insurance, life insurance, and identify who needs coverage. And how much do you need? Well, there's a few different ways we can calculate how much life insurance you need, and that's important. And so if you were going to say, I need X amount of insurance, I think, but I really don't know. I've heard many different financial experts give different reasons and different amounts. So we're going to go through a particular couple of ways to find that out. And I wouldn't be surprised if there's some math on your test, so you might want to pay attention particularly there. We're going to distinguish among various types of life insurance policies and what the advantages and disadvantages are of those policies in particular situations. And then when we wade through all of those things, we're going to choose the best policy for your needs within those particular examples that we'll use, because everybody's situation is different. And then we'll just talk about the key features of the actual policy or contract itself, because the life insurance policy, all of these insurance policies are simply legal contracts between you, the insured, and the owner of the policy, and the insurance company that issues that. Okay? Any questions? About how many people do we have on? I can see two faces. Does anybody know how many we got on?
I think there's 12.
12? Okay.
That's
All
what I
right.
think.
Financial facts or fantasies.
Hey,
The best way to
Shaun.
figure out how much life insurance you need is to use a multiple of your earnings. What would you say? Is that true or false?
I'd say true.
Okay, tell me why.
So your life insurance would probably want to cover like a set amount of years worth of salaries that you would make, and therefore it would be like if you had died for another 20 years or something.
Yeah, that's good. Now, I'm going to say false because what you just said was true, but it's not the whole truth, so to speak. Like when you ever get thrown into court and you have to testify and they say, tell the truth, the whole truth, and nothing but the truth. So this is the truth, but it's not the whole truth. So you could use multiple of salary as part of the analysis, and we'll see this later, but there are other things that you may want to take into account. Your salary right now may not include putting money aside for your future kids' future college tuition. It may not include a number of things that are outside of your salary at this point in your life. So that is part of the calculation, but it is not the whole calculation. However, you will read in certain financial periodicals that 5 times your salary is a good starting point, or everybody needs 10 times their income. Those are just ballpark generalizations. I say this about financial plans. Everybody's personal financial plan, it's like a snowflake. From a distance, they all look the same. But up close, no two individuals or two families' financial needs and goals are the same. And that's why we think it's a good idea to have a professional to talk to so that you can share your goals and your fears with that particular analyst so that they can help you through that and determine what the proper amount is for you and why. Okay. Next one, Social Security survivor benefits should be factored into your life insurance plans if you have a dependent spouse and or minor children. What are Social Security survivor benefits? What does that mean? Anybody want to take a guess?
Maybe is it advantages or like tax cuts maybe, or some added bonus of money you get for your Social Security tax?
Yeah, you're on to it. You're on to it.
I've heard about this actually. If your spouse has a higher income than you and they die, you get their you get the highest of your 2 Social Securities paid every month.
Yep, that's a part of it too. So think of it this way, and we just went through an election period. So I'm not picking sides. I couldn't care less. Well, I shouldn't say it that way. I'm not going to make this political. There's 2 different philosophies out there. One is if we privatize most things and we allow capitalism to run at its purest form, if we could take out the variable of greed, but we can't, it's just part of the human nature. Capitalism in its purest form is going to provide a great economic society for everyone. Well, that's not always true. We know that we need a safety net for certain reasons, for certain segments of the population. So Social Security has 3 components to it to protect people. Somebody alluded to, if somebody died, then I might get their part of their Social Security. What piece of the Social Security system is that? I'll give you a clue. There's disability, there's retirement, and there's life insurance. So Social Security encompasses all 3 of those. So what the young man was saying earlier, if a spouse passes, the surviving spouse gets to choose the higher of the 2 Social Security benefits that were being paid into the household. Is that life insurance, disability insurance, or retirement?
Well, it seems like life insurance to me.
It does, doesn't it?
Retirement.
There's a lot of tricky things here. That's actually part of the retirement component. So when you can go online, and you're young now, so you may not have much earnings accumulated, but you can go online and get a PIN and actually look at your Social Security benefits, and it'll tell you right down to the dollar. If you become disabled, here's how much we're going to pay you. If you died today, here's how much we're going to pay your survivors. And if you live out to your retirement age, here's how much we project you're going to get each month. Because that safety net basically covers this. There's 3 things that are going to happen in your life from an insurance standpoint, at least with life insurance and disability insurance. You're going to live too long. You're going to die too soon. Sometime in between, you're going to get too sick or hurt to work for a while. That's what the statistics are telling us. So with Social Security, it has a death benefit component so that if you have a family with children, and this is the key, if there's no children in the household, it doesn't matter which spouse dies, there's no death benefit. So what we know about the death benefit portion of Social Security is that is really for parents and for children. There's no children in the house. There's no death benefit going to that household. What the young gentleman was talking about earlier was retirement. So let's say that you have husband and wife. They are now fully retired. They've paid in so many dollars in their FICA taxes over the years that accumulated so many credits. And those credits have provided each of them with a particular retirement plan. Let's say the wife is a brain surgeon and was killing it. Well, I guess I shouldn't say that with a brain surgeon, should I? The wife was a brain surgeon and was making a ton of money. And the husband was the janitor at the hospital. His Social Security benefit is going to be significantly lower than hers. So if she predeceases him, the law says that he gets to choose. He can either keep his, or he has the right to take his spouse's. And so in that case, he's going to take the richer benefit. And since she would have paid in more credits, more money over time, her retirement benefit would be higher. So it only makes sense that he would get hers or take her retirement until he dies. The third component is disability. The disability piece says this: if you're too sick or hurt to work, we're going to take a look at how many credits you've accumulated up to the point of when you're disabled. And then we're going to apply that towards your disability payment each month. What they base the amount, the credits, rather than boring you to death, they're going to take a look at what you've paid in on the average over your last 40 quarters or the last 10 years of your FICA payments into the system. And that's what they're basing this on. Now, if you get confused and you get into the future, all you have to do is Google Social Security estimated benefit statements, and you can look all through that and read through it, and it'll tell you exactly how it works. And you can even get a pen and get your own estimated benefit statements. And I tell my clients that's a good thing to do as you go through your life, is maybe once every 2 to 3 years, go in, reprint that form, keep it with you, because it's a great financial planning tool. Because as we're talking about insurance, we have a social insurance system. We have something opposite of pure capitalism. There is a safety net, and Social Security is part of that safety net. It's a social insurance system, okay? And so when you go to figure out how much life insurance you may or may not need, it is a good idea to have that component available for our calculation. So that's a long-winded answer to that bullet point. Third bullet point: term insurance provides nothing more than a stipulated amount of death benefits, and as a result is considered the purest form of life insurance. True or false? Who knows anything about term insurance versus whole life insurance versus universal life, variable life, any of that? What do you know about term insurance?
Nothing.
Nothing? Oh, come on. The answer is a dead giveaway. It's for a particular term, which means you're paying money. Think of your auto insurance, a specific amount of money for a specific period of time or term for a specific amount of coverage. So for life insurance, that is the purest form of insurance. Nobody pays extra money into their auto insurance hoping that there's a side fund that's earning money for them that they can go take out someday and buy a house with or retire on or whatever. Okay, same with your homeowner's coverage, same with your medical insurance. Those are insurance products only. Life insurance has become a financial accumulation vehicle as well. We'll talk about that later. But in its purest form, life insurance, the protection only, is called term insurance because it gives you a stated amount of coverage for a stated term for a stated premium or payment. All right, selecting an insurance company is the first thing you should do when buying life insurance. True or false?
I guess false.
Why would that be false?
You might want to compare different insurance companies and policies to see which one would suit your needs the best.
Absolutely. So if you said, well, I'm going to go out and buy a car, and I'm just going to run to the Ford dealership. I know they've got some new cars. I can't afford those, but they've got some used cars as well. So I've selected a company, and there's my boundary. I can't go outside that boundary. Well, that'd be silly. Why would you shop around, go to different car lots? Look, you know, you guys are a younger generation than me. Probably lots of places that you can find vehicles, even on social media these days. So you'd shop around. So selecting the company first is not the way to go about shopping for insurance. Now, what you're going to see is there are different sales techniques. If you go to a specific place that sells only their product, you might have a general agency, what's called like State Farm or Northwestern Mutual. So if you go to an insurance company, you're talking to them about their product and their product only. If you go to an insurance agency, okay, and I'll just make up some names, Missoula Insurance Agency, Big Sky Insurance Agency. So those agencies generally contract with many insurance companies so that from a sales standpoint, they have a selection, just like a used car lot would have, many different types for many different vehicles, trucks, cars, Ford, Chevy, Dodge, you name it, because as a salesperson, you'll want to have a wide selection so that you can take care of as many customers as you possibly can, thereby building up your clientele and your revenue. Okay? Because most life insurance policies are largely the same, you need not concern yourself with differences in specific contract provisions. That one's pretty easy. What would you guess?
It's not true.
Not true. All life insurance policies, all car insurance policies, they're all contracts. None of them have the same exact language. Not that you should bore yourself to death with reading every car insurance contract, because when you hear an ad for Geico versus Progressive versus whatever funny commercial is on during the day, and they're all telling you you can save money, it depends. If you read the contract, you can find out where you can save money and why. There's a lot of people that go out and buy whatever sounds good, and later on come to find out, well, this isn't what the TV commercial said. I didn't save 15% in 15 minutes. So make sure that you read the contract, because the devil's in the details, okay? Not just what's price. We tend to be price oriented. Well, what happens if I get into an accident? Same thing with life insurance. What happens if I die a particular way? Is that even a covered event? Most things are covered. Some things are not. All right, so any questions on the facts or fantasies part?
I had a question in general on who should get life insurance, and like if you're single and have like live by yourself and things like that, is there any real point in having life insurance if you have no dependents?
Let's do this. When we go to the calculation page, ask me that question. Okay? It's a great question. So life insurance helps to replace lost income if somebody dies, and provides funds for loved ones so they can keep their home and maintain their acceptable style of life, pay for education, meet other needs. So that's true, but keep in mind, we already hinted that there may be other reasons to buy life insurance rather than just replacing income. the basic concept of insurance is risk. And if I was a student, I'd say, boy, I'll bet you this is going to be on the test. What's the definition of insurance? Well, its risk is defined as an uncertainty concerning a potential economic loss. So that is definitely a risk financially. There's all sorts of other risks in life. You don't want to go whitewater kayaking and accidentally forget your life jacket and your helmet and say, what the heck, I'm going to go anyway. So different types of risk. The simplest way to deal with risk is to avoid the act that creates it. So Life Insurance 101 or Insurance 101, some of the books I had to study to get licensed, it goes over this specific slide. Well, what is risk? What's the easiest way to mitigate risk? Well, I'll never die from skydiving if I never go skydiving. So the easiest way to guard against risk is to avoid it altogether. Okay? There's risk in everything. And that's why there's insurance for almost everything. You'd be surprised to hear the number of things that you can insure. You can insure financial deals. Athletes can insure their bodies. You can insure some of those contracts those athletes make. Crazy things that you can insure. So as you live with risk, you just have to assume that there's going to be some things that you can't control. We can't control everything. And in fact, it would be a really frustrating, anxiety life if we had to think about every moment the risks that are coming along. If we're walking around downtown and going across Higgins Street and the light is green for us, but we're going to check and make sure there isn't a car within 100 yards just to make sure I don't get run over, it kind of ruins your life. So you just have to assume that there are some risks that you're going to be able to control, some risks that you can't control, and then some risks that you can't control that you may choose to insure. Okay? So loss control is the activity that lessens the severity of loss once it occurs. So you wear your seatbelt, you don't drink and drive, you eat healthy, you don't smoke, and then you transfer some of that risk to a company. Okay? So your actions matter. Now, with this slide, it doesn't really matter who you're transferring your risk to or what it's for, whether it's auto insurance or life insurance or whatever. The way you live also determines if you can transfer the risk. So tell me again, what might be an item that's on that slide that would disqualify you from getting auto insurance?
Like your driving record?
Yeah, if you have a DUI, what's the chances of you being able to buy auto insurance? Slim to none. Now, some companies will insure that person, but your rates just went way up. Okay, so there's a direct correlation between cost and risk, and a direct correlation as to whether you're even insurable. Okay, so you cannot transfer 100% of your risk. Your actions matter. In fact, I would say this, sometimes you can't transfer any of your risk based on how you live your life. How do they determine whether you get insured or not? Well, that's called underwriting. And insurance companies decide who gets insured and the rate that's going to be charged, and they combine the losses and those, or the loss experience on the law of large numbers. So I'm sure they still have statistics classes for business. How many of you have taken statistics classes? It's all about probability, and those probabilities are based on a certain set of numbers and subsets. So not only do they look at an overall general picture of, gee, Shaun, you're 57 years old, your life expectancy is 85, let's say, that's pretty close. But if I get to age 80, my life expectancy has gone up. Somebody'd say, well, why is that? Why has it changed? Well, because I actually made it to age 80 and my health is still good, so my projection is going to be longer. So they take a look at the actuarial data. So whenever they underwrite a person, they don't simply look at the general population. They take a look at your health, take a look at what you do for a job, they take a look at your driving record, your criminal record, any record that's on you, anything connected to you, that gets taken into consideration. And so in this day and age of social media, employers are looking at Facebook to see if they can find out something about the people that are coming in for job applications. Insurance companies look for those same things. It's only a click away, so why wouldn't they investigate? So whenever people are taking a look at you, they're deciding whatever's connected to your body, how risky is this person? And then they make their decision based on that. So it's both based on a large group, but it's also based on you individually, okay? And so that's what the next bullet point is. They guard against adverse selection. So again, that person that has a DUI, I actually have a case right now, 2 gentlemen that just opened a well and drilling business, and they're both mid-30s. And in order for them to secure the financing from the bank to buy the equipment to get their business going, the bank said, if something happens to either one of you, we want our money back. So we want some life insurance on you guys. And both of them have multiple DUIs. And I hated to break it to them because they're probably going to go back to the lender and say, we couldn't get any life insurance. And there's a really good chance the lender's going to say, I'm sorry, we're not going to loan you the money. And these 2 guys are going to have to go work for somebody else again because they can't start their own business just because of the risk that they have that keeps following them. Now, as time goes by, those risks go away, so to speak, because the further you get away from that activity, let's say that you're not skydiving anymore, or if you haven't had a DUI for 5 to 10 years, now the insurance companies will look at it differently. So you have to keep that in mind, that what you do not only in the future, but what you do now may follow you as far as your insurance pricing, okay? So how do underwriters determine the criteria for classifying people that they choose to insure? Well, it varies between companies. Like I said earlier, some companies will go ahead and insure you. They might just jack the rate way up. Other companies are going to say, we wouldn't touch you with a 10-foot pole, but for the people who have good records, those are the companies they're going to shop with because they know that they're priced less expensive because they're covering people who aren't very risky. Next one. Benefits of life insurance, again, financial protection for your dependents. It's protection from creditors. The benefits are paid to a named beneficiary and not accessible to your creditors. So that's a particular hitch with life insurance. And I need to explain this. It's almost correct. If you have life insurance that has a cash value building component with it, in other words, it's not term insurance, it's a kind of insurance where you're actually accumulating money in the policy, just like if you were accumulating money in a bank account. So think of that type of life insurance, whole life, universal life. There's a lot of cash value policies where you have the insurance and you have a savings component, and they're put together. If you have a debt to a creditor, currently the law says they can't attack your life insurance policy. They can't get inside your life insurance policy. However, keep this in mind, if you were to pass away, but your estate, when you died, got a whole bunch of money, then that is now part of your estate. And if your estate has creditors, they have every right to sue to get their fair share of money that your estate owes them. Okay, so that particular line is partially true. So just think of it this way. They can't get the money in the policy, but once a claim is paid and the beneficiary of that receives the money, if it's your estate rather than another person, then yeah, creditors have access to that. Tax benefit. Proceeds from life insurance are generally not taxable. That's true. So if you're married, you have a spouse, your spouse is the beneficiary, and you pass away, the life insurance benefits are all income tax free. And that's important to keep in mind because there's different types of taxes. There's capital gains taxes, there's estate taxes, there's property taxes, there's all sorts of taxes. But what this one is talking about is if you had $1 million life insurance policy, your wife was the beneficiary, or I should say your spouse is the beneficiary, you die, your spouse gets $1 million and does not have to pay any income tax on it. It does not go on the 1040 form as income, and it escapes income taxation. Okay? If you're very wealthy, Bill Gates, who already has with an estate tax problem because he's so wealthy, if he and his wife pass, the government's going to take a whole bunch of their money. If he bought life insurance and left that to his spouse, that's going to be subject to estate taxes. So again, that one particular line is true, but it's true only for income tax. Okay? And it can be a vehicle for savings, though not the best vehicle. So what that means is this, is if I, as an insurance agent, and I also sell securities, when a client asks me, he says, hey, I just had a newborn baby, what's the best way to save to help put her through college? I would say, well, let's get into the stock market and look at some growth funds if you want mutual funds, or let's pick a good stock portfolio. And over time, that should have a better return than fixed interest assets. And so by doing that, we're looking at a long-term growth. And I would say you probably don't want to use life insurance as your savings vehicle because it's not going to grow as fast, historically speaking, as other growth assets have. However, the insurance companies are pretty smart. One of the many types of cash value policies that they have is they say this, well, why don't we make the savings account that's attached to the life insurance a whole list of mutual funds, and they can pick whatever mutual fund they want. And that particular type of life insurance is called variable life insurance. The reason it's called variable is because it's just like the stock market. You buy shares, your value goes up, it goes down, just as the market itself goes up and down. And so some people that buy life insurance will buy that type of life insurance because in addition to it being income tax free at death, and it has creditor protection while the money is still in the policy, it also grows tax deferred like an IRA or a company sponsored 401k, or if you have a retirement plan at the U of M, it's a 403b. So any of those tax advantage plans, life insurance has that same component. So although it may not have the best rate of return, when you take a look at your tax bracket, there are a lot of wealthy people that will pour money into life insurance contracts because all of their earnings are tax deferred. And it grows and grows and grows without being taxed over the lifetime of that. And if you want to take some risk, you can buy funds and securities along with the life insurance protection all in one package. All right, everybody still awake? All right. Somebody asked me this question. Who asked the question? Ask it again.
That was me asking if you're single.
Okay, tell me a reason that a single person might need life insurance.
I would say if you had assets that would be covered and you wanted your extended family to receive them, like your parents or grandparents to receive assets you had in your life, and that would help cover that and allow them to take control of them.
Okay. So let's play this out. Can I use you as an example? What's your name?
I'm Gabe.
Gabe. Okay. So Gabe, I'm going to make up you. I don't know you at all, so I'm just going to make stuff up, right? So this isn't really Gabe, but we're going to pretend this is what Gabe's life consists of. So he's a single person. Gabe bought a house, and he's smart because he knows if he rents it out to a few college buddies while they're in college, he's collecting some rents, helping him pay the mortgage, helping him pay the bills. And as time goes by, the pricing of housing almost always goes up. Doesn't always go up, but almost always goes up, especially in this town. Housing's pretty darn expensive. And so he buys a house, and over some time, even after his college buddies have moved out and he owns the house all by himself and he lives by himself, let's say that he bought it for $300,000 whenever, 5 years ago. The house is now worth $350,000. So there's some equity there. In addition to that, he paid down his debt a little bit. So let's say he paid it down to, for whatever reason, $275,000. So how much equity is now in Gabe's house? $350,000 minus $275,000.
75,000.
75 grand. So if Gabe has a will, and again, life insurance extends into your own personal estate planning. If Gabe has a will, in his will, he's going to say who gets what. And so if he says, I want to leave my house to my sibling, brother or sister, and the sibling says, well, that sounds great. I'm glad you put me in your will, bro. But if I took over your house, I can't afford the payments. What's one of the things that Gabe could say to guarantee that the sibling will get the house and not have to worry about it financially?
Yeah, I could have a policy that would pay for the house.
Yeah. So what if Gabe just simply buys a life insurance policy, names the sister in this example as the beneficiary? At the time he bought it, it was worth $300,000 because that's what he bought the house for. Writes that in the will. Gabe passes away. She gets the house and she says, great, now I get the payments too. But oh yeah, I just got a check, tax-free. I don't have to pay any taxes on this. So I got the whole $300,000. I can either just go to the bank and pay it off and still have $25,000 left over because there's only a $275,000 debt. Or what I can do is I can just make monthly payments on it because interest rates are so low. Well, why would I pay off that debt? That's really low. Then I'll take the balance of that $300,000 and I'll invest it in the stock market. I'll make more money than they're charging me on my mortgage. Okay. So there's a situation where even a single person who wants to leave things in their estate to other people, but don't want to burden them with the financial baggage that comes with some of those items, they may buy life insurance. Okay. And then there's many, many, many reasons why, but here's another one for those of you who have a charitable bent. Some people that are single buy life insurance because they're able to donate to a cause that they like. They donate a little bit here and there. They volunteer for it. They're really passionate about it. And they see some of these wealthy people writing big checks and they say, gee, I wish I could do that. Well, some people buy life insurance so that if they pass away, that donation of time and talent and treasure from them going to whatever charity won't stop, because at their death, they've named the charity the beneficiary and the charity gets a windfall. So that's another reason single people buy life insurance, is to leave something to a charity. So the mantra for life insurance is this: people who buy life insurance because they either owe somebody money or they love somebody. That's why you buy life insurance. Okay. For funeral costs, yes. I mean, if you're going to have funeral costs and hospital costs at the end of life, most people don't get hit by lightning. They pass away over some period of time that takes medical care. Health insurance doesn't take care of all of the bills. So we usually put in the calculation a fudge factor to have some insurance behind for what we call final expenses, for funeral and end of life, which usually means hospice care, medication, things that your insurance isn't going to cover. How much life insurance? So let's get into this. Here's worksheet 8.1. So step one, what's your total economic need? What you're really going to do in this part is you're going to run a budget. That's the simplest way to put it. Find your budget, be realistic about it. The best way to set a budget is to take a look at your credit card statement. And if you still have checkbook, I know a lot of people, my daughter's your guys' age, she doesn't have a checkbook. She does everything through cards. So find things that are going to reflect your expenses. If I was a detective and somebody said, hey, I want you to find out about Charlie Brown, first thing I'd say is get me his credit card statements and get me his checkbook, because I can find out a lot about him by see where they're spending their money. Same thing with yourself. A lot of times when I do financial planning, I'll ask someone, how much money do you make? And they'll say, oh, I take home about $5,000 a month. Oh, okay. And so how much does it cost for you to live? And they'll start adding stuff up in their head. Well, mortgage is this much, the car payment, yeah, and then well, blah, blah. And so they get to a number and I say, oh, well, that's $4,000. So you must be able to save $1,000 a month every month in the bank. Oh God, no, I don't have that much money. All right, well, let's get out your credit card statements and see where you're spending your money. So do a budget, go line item by line item and find out how much are you really spending each month. That's the long way. The easy way is this: if you bring home $5,000 and at the end of the month you don't have anything to save, you're spending $5,000. Next step, determine what financial resources will be available after death. Here's Social Security. What did we already learn about Social Security if you're a single guy? Anybody getting any Social Security if you die? No, you don't have any kids. Okay. How about current savings and investments? How much do you have in checking, savings? How much do you have tucked away that your parents or yourself may have put into some investment accounts? Do you have other life insurance? All of these things are resources. There might be some other ones out there. Who knows? There might be something waiting for you. Your grandfather may have some sort of plan for his grandchildren. I mean, if I die, my grandson's going to get a pretty good chunk of change. Now, he's not going to get it because he's only one, but it's going to go into a trust for him and it's going to grow. And then when he's ready to go to college, there's some rules I wrote in the trust, but basically he gets some money. So you never know where those resources might be coming from. And then the last step is you subtract one from the other. What do I have and what are my needs? And then you come up with that additional amount. So this worksheet is one way to do it. Okay, monthly living expenses, net yearly income. So this particular life insurance needs analysis form, I'm not going to go through it and bore you to death. As you can tell, I'm a talker. I would become familiar with this form.
Can I just interject something really quick?
Absolutely.
Thank you. So, gosh, I've already learned so much. So this sheet, y'all, is what you're going to be doing for your assignment for this chapter. And as Shaun astutely pointed out, probably would be something that you'll be tested on at some point. So I know it's too small to actually see here the very specifics, but just, because it's a little micro image, but just follow the basic logic of the first section, compiling everything that you think you're gonna need, and then comparing that to everything that your person that you're trying to help with the life insurance is going to have, and the difference, you might find like, I don't need life insurance, or you might come up with a number at the bottom that says, oh, I need $400,000 of life insurance. There's a really good example in the book, so I would encourage you to take a look at that at a pretty detailed level before you jump into the homework. So just wanted to point that out. Thanks.
Okay, thanks, Lisa. What kind of policy? Now, if you're on a tight budget, and let's say that you were working with me for whatever weird reason, maybe somebody said, hey, this is the guy to go see. He can help you with investing money and insuring your lifestyle, and he can talk to you. It's not just a money guy. He'll ask you what's important. Do you have a charitable bent? Do you have children that you want to take care of? So we come to this conclusion as we go through that analysis together. You have some needs, but you don't have some money. I mean, it's tight. But if you go, you're leaving responsibilities behind that are unfunded. Which of those types of policies do you think I'm going to recommend? Which one's the least expensive?
Probably term life.
Yep, term. Why? Because I told you before, there's no savings component. So let's pretend you pay $25 a month for your term insurance, or you can pay $25 a month for the insurance component of whole life and universal life, and then you can put another $75 a month in as part of the savings. So now you're paying $100 a month and you're saving some money through life insurance, but really you're like, dude, I don't have the extra $75. I just need to make sure if something happens to me, this person or these people are protected. So which is the cheapest of these? I go, well, remember the purest form of life insurance is term insurance. So let's buy term insurance. So 90% of policies sold out there are term insurance simply because it's the least expensive way to get the risk covered, okay? So you have a specific amount of protection. Well, we already went through this. It's the simplest. It's just like your auto insurance. Premium, specific. Time frame, specific. Amount of coverage, specific. Straight term. So straight term does this. Your coverage remains the same. So in the example that we used with Gabe, he bought a $300,000 policy. Let's assume that it's term insurance. He can have that same exact death benefit for the rest of his life, whether it's a year or whether it's 50 years. But the premiums might increase at some point in time. Okay, so you can have what's called straight term or level term insurance, which means the death benefit stays the same. It's level. You can also have, if you want to pay extra upfront, you can have level premium term insurance, because we know as you get older, I'm going to see if this works here. Here's my life expectancy. Every year that I get closer to that life expectancy and me dying and the insurance company having to pay a benefit out to my beneficiary, you think the insurance is getting more expensive, staying the same, or getting less expensive?
More expensive.
More expensive. Greater the chance they have to make that claim, the more expensive it gets. So what happens is all life insurance, the cost of the insurance itself goes up every single year. However, you can buy what's called level term insurance to where the price stays the same the whole time. The difference is this: you're just going to pay more upfront to begin with, and then it's going to stay that same price for whatever length of time you chose, 10 years, 20 years, 30 years, whatever. And so even though the actual cost and price for the insurance technically goes up every year, because you're overpaying in the early years, you don't have to pay any more in the later years, and it all levels out. A lot of people buy level term insurance for two reasons. Number one, they want to guarantee that death benefit. They want to know it's going to be there the whole time. And once they put it in their budget, they know it's not going to change for the next 10, 20, 30 years, however long they bought it for, okay? Decreasing term means this: it's just the flip side. It's just a reciprocal. The premiums remain the same, but as time goes by, the coverage goes down. And again, the reason is because the insurance costs go up. And so as the insurance costs go up, if the premium is the same, well, then the benefits got to come down to match that. Okay? And mortgages, banks, and I'll tell you this right now, unless you're unhealthy, don't buy mortgage insurance from the bank in the sense that, hey, if you die, we got this product that'll go ahead and cover your mortgage. Okay, well, how much is that? So they tell you whatever the price is. And then you say, so let me get this straight. So I'm going to pay this much money. And as my mortgage goes down, the death benefit that's going to come out is going to be exactly equal to the mortgage. What if I only have like $20,000 left on my mortgage? I'm still paying the same price? Yep. So I always recommend to people to check and get quotes on individual life insurance, the term insurance, where you do not have a decreasing premium, because you can usually get more death benefit per dollar rather than buying what we call mortgage insurance through a mortgage lender. And trust me, I just bought a new house about 2 years ago, and I must get one letter a month asking me to buy mortgage life insurance. And I'm thinking, geez, this stuff's a ripoff. Now, where wouldn't that be a ripoff? Where would the offer that the bank is giving, which is guaranteed, they're not going through any underwriting, when's that a good deal? Remember, they're insuring the risk of who? Of you, your body, right? And what you do with your body. Okay, so if I'm a burger eating, beer drinking, DUI getting dude, and I can't get insurance anywhere else, the offer the bank's giving me and saying, oh, by the way, we just give you this, you got to pay for it, but we're not going to do any checking up on you. I'd say, yeah, I better get that, because no one else is going to insure me. So keep that in mind. Important features of term insurance. So it automatically renews every year. So every year that you pay your premium, it renews without evidence of insurability. In other words, you don't have to prove that you're healthy and that your driving record is good every year. They just send you a bill and it renews. If you quit company A and you say, I'm going to go to company B, it's a brand new risk for company B. So you're going to have to prove to them through the application and the physical exam that they're going to have you take, which they will pay for, but you still have to go through it to secure the new insurance. So sometimes people stay with the insurance company they're with because they think, yeah, I might save a couple dollars a month, but I'm not going through that hassle all over again to prove I'm insurable. And especially if their health has taken a turn for the worse, okay? Oh, and you can convert your term policy to any type of cash value policy without showing that you're healthy, because if you bought a $300,000 term policy and you say, hey, I want it to be a whole life policy, well, they're only on the hook for $300,000, so they don't give a hoot or a holler if you want to pay them more money. You want to pay them more money and put a side fund in there. They haven't increased their risk, so of course they're going to convert it automatically. That's not a problem. So here's an example of term life insurance. Yeah, and I really wouldn't put much credence in this table because this is just a generalization. Here's what I tell all my clients when they ask me for quotes. I say the best thing to do is to put you through the underwriting process, because the quotes that I give you are just a general price. It may or may not come back that way. And the last thing I want to do is overpromise and underdeliver. So I can't tell you that it's going to cost you, in this case for a 40-year-old male, this time frame, $297. And too many purchasers lock in on that. And when the policy comes back, they say, well, what do you mean it's $300? I thought it was $297. I'm like, really, dude? You're going to rake me over the coals over $3? So this is just a generalization. The best way to get a price is to go through the underwriting process. Just because you apply for insurance and go through the underwriting process does not obligate you to buy the policy. In fact, if you don't write them a check, trust me, they'll never issue the policy. And so that's what I tell my clients. Let's just apply for it and see what they're going to price you at. Then, and only then, do we have enough information to make a buying decision. Nobody goes to a car lot and then just picks one out and says, well, I'm going to test drive that, and gets out of the car saying, well, I guess I got to buy it because I drove it. Life insurance is the same way. Advantages.
I have a
Economical way for
question.
young people to purchase large amounts of life insurance. Yep. Again, term insurance, it's the cheapest way. It provides.
Shaun, we had somebody with a question.
Oh yeah, go for it.
I had a question about the last slide. So it just seems like throughout all the ages, females it was a lower policy than males. Why is that?
That's a good question. Answer that for me.
Would it be because males are probably a little more risky than females?
That could be the reason, but the reason is who has a higher life expectancy? Who lives longer? Which gender?
Women, female.
Women live longer. So the theory here is this. Let's look at the 60-year-olds, the males versus the females. They collect less money per year on the female because they assume they're going to be collecting for more years because the women live longer.
Oh, okay.
So at the end of the day, assuming, and again, this is just the assumption, they're going to collect the same amount of money. Here's an interesting fact for you. The only state in the country that has unisex rates, there is no difference between males and females, is Montana. I won't give you the history of why, but the females that wanted unisex rates, the insurance industry said, really? You realize it's going to cost you more money because we're going to blend those rates. If we're unisex, everybody gets the same price, males and females. So you're actually going to be paying for more. And so if I have a client that lives out of state, I always say this: if we sell you the life insurance, we're going to take the application and get it done in your state because it's cheaper. So I'm glad you picked up on that. That's a great question. All right. So we got, what, half an hour left, roughly, a little less. Whole life insurance provides insurance during the person's entire life. That's where it gets its name. It's for your whole life. Well, how can it pay for my whole life? What if I die at age 200? That's the insurance risk. They've taken that risk. You're going to put so much money into your side fund or your investment fund that blends in with the life insurance policy. You're going to be paying so much more over and above just the term cost that amount of money is going to be sitting in that side fund, guaranteeing that if you live to be 120 years old, the life insurance policy is still going to be there. Okay. So sometimes people will buy whole life insurance or any type of permanent or cash value insurance because they say, I want the insurance in force the day I die. I don't care if it's tomorrow or I'm 99 years old. I want my insurance to pay out. Other people, when they do their financial planning, will say, well, the kids are gone. They're up and on their own. They're doing well. So I don't have that responsibility. The mortgage is paid off. I don't have that responsibility. I have, or if you're married, I and my spouse have money in the retirement plans. So if something happens to either one of us, the other one of us gets all of the retirement money. Well, I don't think we need insurance anymore, Shaun. And so there are a lot of people that will buy term insurance because they know a lot of those responsibilities go away over time, and that's a less expensive way to insure against risks over a specific time period. So it can last your whole life. The death protection also has that savings feature. So if instead of leaving all of the money there to continue to pay premiums, even when you're very, very old, You can access it for whatever you want. You want to go buy a boat, go do it. You want to put your kid through college, if you have enough in there, go for it. You want to put a down payment on a different house, you have access to those savings in there, okay? And you have that right to the cash value. Does that make sense? Basically a savings account with a life insurance term policy attached to it. So here's how the cash value and the death protection works. It's an inverse relationship, very simple graph. As a person gets older and they put more money into their cash value life insurance plan, just like if you're putting money in the bank, what happens to the value of the money? Goes up, 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 up. So in this case, where there's $200,000 at the very top, if you've put in $200,000 of your own cash on a whole life policy that pays out a death benefit at $200,000, what that means is that you get the death benefit of 200, but it's really all your money, isn't it? Because you've paid it in over the years and the interest and earnings have grown to $200,000. So conversely, we can say, well, how much real death benefit is there? At age 40, there's only $20,000 of cash. That means 180 of the $200,000 payout is coming from the insurance company. So anywhere in the white, that's the death protection. That's the insurance protection. Anywhere in the blue, that's your own money. You're just getting it back. Premiums, let's skip that again because it's not accurate. Types of whole life policies, all you need to know is this. The more money you pay, the quicker it pays up. So you can pay it for your whole life and just keep paying premiums forever and ever, amen? Or you can pay a whole bunch of money and say, I want it paid for at a certain date, just like a house. If you say, here's my mortgage over 30 years, but if I accelerate the payments, maybe I get it paid off in 20 years or 25 years. You can do the same thing with life insurance. In fact, if you're rich, you could just put in one lump sum amount of money at the very beginning and pay for it all right up front, just like you could with a house or a car or anything else, okay? Obviously, the quicker you get something paid off, the less expensive it is because you're not paying any interest expense, correct? So advantages of whole life, really this is just talking about the savings part of it. There's a savings vehicle where you can get cash out, your premiums don't go up, and all of that cash, as I mentioned earlier, accumulates tax-free. Okay, but just like any other retirement account, once you pull it out, that's when you have to pay the taxes due. Okay, so if you put $100 in cash in, it grows to $200 of cash, or let's say $250. You have a gain of how much? You put in 100, you now have 250. What's your gain?
Just 150, but you have to tax it.
So how much of that 250 you pull out is taxable? Only the earnings.
The 100.
Your own money, you get back tax-free. Any earnings are subject to taxes. Just like savings in a bank. Every year you guys probably get a statement from a bank that tells you how much interest you earned, and you got to add that onto your 1040 and pay taxes. But your own money that you put in, that you'd already paid taxes on, they don't tax you on that again. They just tax you on the earnings only. Same with life insurance. The disadvantage, we already talked about this, less death benefit. Well, it's not necessarily less death benefit. It's just that if you have a specific budget and you can only afford $50 a month, you're going to get less protection for your loved ones than you would if you just bought term insurance. The savings, it's not like being in the stock market where you have the opportunity for growth at a higher rate. Now, of course, with the stock market, there's the risk that your money could go backwards as well. But if you're looking for savings potential over the long term, growth stocks have always outpaced the returns of fixed interest assets like whole life insurance. Tax penalties on early withdrawal. That's not true. Your tax penalty is if you pull money out and you don't pay the taxes on it, then the IRS could penalize you. But no, there's no penalty. You just pay the tax that's due at the time. Okay. Outstanding loan subtracted from the face value. Yes. So if you had a life insurance policy that's worth $1 million, you had saved $250,000 in it, you had put in $100,000, and one of the things you can do, as we talked about, is take it out to go buy a boat. And you do that, you buy a really expensive boat and you take out a couple $100,000 and you borrow money out rather than just withdraw it. If you die, they just simply subtract the loan outstanding that you took to go buy the boat from the death benefit that's going to your beneficiary. Okay.
Shaun, I'm sorry, if it's okay. We've got about 8 minutes left.
Oh, 8 minutes. Okay.
Yeah, sorry. I guess I didn't tell you that it stops at 3:20. So is this a reasonable time to have them weigh in with some questions, or do you want any parting words, or?
Yeah, I would say, a lot of this is the same stuff. What's right for you? Contract features is boring. Other features is boring. Okay. So I would say this is probably the best slide on the whole thing. What type of insurance is right for you? Okay. Because you need to go find out, just like shopping for a car, you need to go find out. Look around, shop around. All of these life insurance things are available to look at on websites. Search them out. But I think the best thing to do is to go to an agent who can give you good information and truly can help you. Like any walk of life, there are some agents out there that will just tell you whatever they want to tell you so that they can make a buck. But go talk to more than one agent and you'll figure out pretty quickly who's really interested in you and who's interested in them.